Welcome back to Patrick Boyle on Finance. While my YouTube channel is a finance channel, a lot of the YouTube videos that I watch are guitar channels. I've unfortunately been a beginner on the guitar for the last 14 years and I'll probably continue to be for life. A lot of the guitar channels that I do watch have been discussing the goings-on at Guitar Center, a company which has been struggling financially for quite a while now. The news at the moment out of Guitar Center is that they're filing for a Chapter 11 bankruptcy protection. So in today's video, we're going to look at what is going on there and how they're restructuring. We'll discuss what it means for suppliers, customers, employees, and the commercial landlords renting store space to Guitar Center. I'll put some timestamps in the video description below so that you can skip ahead to the sections you are most interested in. So Guitar Center has been around for quite a while. It was founded in 1959 initially as the Organ Center, where they originally sold organs. Electrical musical organs, and shortly afterwards they transformed into the Vox Center, where they sold Vox guitars and amps, which were very popular with the British bands of the 1960s. In 1971 they were renamed Guitar Center and they opened their second store in 1972. Today they are the largest American music retailer with 269 locations. They first went public in 1997 and have numerous subsidiaries including Music and Arts, Musician's Friend, Woodwind and Brasswind, and a few others. In October 2007, right before the credit crunch, Bain Capital, a private equity firm, bought Guitar Center out for $2.1 billion. Bain took an equity stake of around 20%, financing the rest of the deal with debt. This is what's known as a leveraged buyout. And if you want to read more about how LBOs work, a big chunk of my corporate finance book, which I've linked to in the video description below, is devoted to that topic. Anyhow, neither the credit crunch nor the period after it was very good to retail stores or to musical instrument sellers. And in April 2014, Ares Capital, one of the largest direct lenders in the United States, converted their debt into equity. Ares transformed from primary creditor or lender to primary owner, with Bain Capital keeping a sliver of interest. This takeover reduced Guitar Center's obligations by about $500 million and chopped more than $70 million from its annual interest payments. While this allowed Guitar Center to limp along, it did not help that interest in guitar-based music has decreased since then, and guitar sales have fallen globally by about a third since that 2014 deal. So where does that bring us to today? Well, in October, Guitar Center missed the interest payments on its bonds due in 2021 and 2022 and was left operating under a 30-day grace period that expires around the end of the week. On Friday, Guitar Center announced that they expected to file for Chapter 11 bankruptcy protection after reaching an agreement to restructure its debt. This plan includes $165 million in new equity being invested by Ares, along with the Carlyle Group and Brigade Capital Management. This restructuring process reduces Guitar Center's debt by almost $800 million and brings in an incremental $375 million in financing from certain existing note holders and lenders, and also $335 million in new senior secured notes. So that's $175 million in new equity and $710 million in new debt, and $800 million of old debt being written off. So first up, let's explain what Chapter 11 bankruptcy is. When a business can no longer service its debt or pay its creditors, the business or its creditors can file with federal bankruptcy court for protection under either Chapter 7 or Chapter 11. In Chapter 7, the business ceases operations. A trustee sells all of its assets and then distributes the proceeds to its creditors. Any residual amount is then returned to the owners of the company. This is a liquidation scenario, which is not what's happening with Guitar Center. In most instances, the original debtor remains in control of the business operations as a debtor in possession or DIP and is subject to the oversight of the court. This is the situation Guitar Center is in. A Chapter 11 bankruptcy results in one of three outcomes for the debtor: reorganization, conversion to Chapter 7, or dismissal. In order for Guitar Center to reorganize, they must file and the court must accept a plan of reorganization. The plan is basically a compromise between the major stakeholders in the case, including the debtor and its creditors. In a Chapter 11 bankruptcy, the company is usually recapitalized, meaning more money is put in, by either a new or existing investor who expects to generate a healthy return on this new investment. The goal is that the company emerges from bankruptcy with more equity and less debt. This deal is what's known as a pre-packaged bankruptcy. It's referred to as pre-packaged because the restructure plan is agreed upon by the various stakeholders in advance of a Chapter 11 filing. So that's what a pre-packaged Chapter 11 bankruptcy is. Now, how do they get rid of the $800 million in debt? Well, Guitar Center has been in distress for a while, and as I mentioned, they missed a bond interest payment last month. They've a large amount of debt outstanding, some of it coming due very soon. They were unlikely to be able to pay off that debt on time, so the debt itself will have fallen in value significantly. Debt or bonds which are not distressed trade near 100 cents on the dollar, meaning that the lender expects to recoup both the face value of the loan or principal invested, plus the interest rate on the debt. This would not have been the case for Guitar Center debt, which would have been trading at some discount to 100 cents on the dollar. Let's say Guitar Center's debt was trading at 40 cents on the dollar. Well, those lenders have to agree that that is probably all it's worth and agree to only be paid back maybe a little bit over 40 cents on the dollar. If they did not agree to this, they might not get anything back. Reducing the debt load like this, agreeing to a haircut on the loan principal value, and possibly accepting some equity in exchange allows other investors to lend new money to Guitar Center and to invest in the equity too. It's worth noting that a lot of the YouTube guitar channels pointed out that many Guitar Center stores had very few new guitars in them, and were mostly selling used guitars that they had taken in on trade over the last few months. Now, there's been a lot of demand for guitars over the working from home period and lockdown, but this might also be due to the reluctance of the big guitar manufacturers to extend trade credit to Guitar Center when they're quite behind on their bills. Without this restructuring, Guitar Center might have struggled to remain in business with no stock to sell. It's worth noting that Fender, the largest guitar maker, is reporting that 2020 is their best year ever in terms of guitar sales. So what is the deal with this new debt? Well, over half of it is DIP financing and asset-backed loans. DIP financing, which stands for debtor in possession financing, is a special form of financing provided for companies that are undergoing restructuring under corporate bankruptcy. Usually this debt is senior to all other debt and any other securities issued by a company. That means that they would get paid back first if the business failed. DIP financing can be used to keep a business operating until it can be sold as a going concern, if this is likely to provide a greater return to creditors than the firm's closure and a liquidation of assets. It may also give a troubled company a new start under strict conditions. Asset-based lending is exactly what it sounds like. It's the business of lending money in an agreement that is secured or backed by collateral. An asset-based loan or line of credit may be secured by inventory, accounts receivable, equipment, or other property owned by the borrower. The final $335 million is in senior secured notes. The investment bank UBS will be selling these, and this is debt that takes priority over other unsecured or otherwise more junior debt owed by Guitar Center. So how might Guitar Center emerge from this? Well, firstly, they'll have more capital to pay their suppliers with. In addition, they'll have less debt, which will likely be longer dated. In addition, under the US Bankruptcy Code, commercial tenants that have filed for Chapter 11 typically have the option to assume or reject any of their commercial leases. If the business wants to remain in the business premises and keep the commercial lease as it is, then they would assume the lease. If they don't want to do that, they can reject the lease. This means that Guitar Center may be able to get out of a number of their less attractive leases on underperforming stores. Philip McKnight, a guitar YouTuber, puts forth that they may close between 50 and 100 of their 269 stores. I'll link to his video in the description below. While there are reports of high demand for guitars this year due to lockdowns and working from home, Guitar Center own a number of other brands like Music and Arts and Woodwind and Brasswind. These stores sell band instruments, and orchestral bands are no longer practicing, in particular with wind instruments due to the pandemic. Guitar Center have also focused on music lessons in recent years, and that business has not done well under social distancing either. So they may reduce store count and renegotiate other leases. Odds are they can push their landlords to significantly reduce their rent in the current retail environment. Guitar Centers say that they'll continue to run their stores, to receive goods and to ship customer orders as usual. All merchandise credit, prepaid lessons, rentals, gift cards, deposits, orders and financing and warranties will be honoured. So as a customer, you'll probably be okay. But equally, I would not rush to buy someone a Guitar Center gift certificate for their Christmas present. It's worth noting that just because they honour things like prepaid lessons doesn't mean they'll keep your local store open, and so you might not want to drive to another state in order to continue the lesson bundle that you've prepaid for. So you should probably keep that in mind when thinking about prepaying for a lot of lessons. So a lot of musicians want to know, will there be big guitar sales? Well, Philip McKnight has discussed this on his channel, and he argues that there might be. Guitar Center don't have warehouses. They use their stores to keep the goods that they sell in storage, and in the event of store closures, they may liquidate the goods online rather than shipping them to other stores. In particular, the used guitars and open box items might be liquidated, so there may be some good deals in the pipeline. There will be a lot more news on this coming out over the next few weeks, and so I'll occasionally post news updates in the comment section below this video. Hopefully you enjoyed this video. If so, do hit the like button, and if you want to see more finance content like this, hit the subscribe button. Talk to you later. Bye.
Can I put the fender back now, please?
Not today, my good man. I'm feeling saucy. I think I'm gonna buy it.